So welcome, Doug. Appreciate you joining us today.
That sounds good. Just want to make sure you guys can hear me.
Yes, I can. Thank you.
Okay, excellent. So are you ready for, well, we were talking about, or going to talk about indirect lending, some of the best practice type of things, if that's okay with you guys. If it's all right, I'll share my screen, go through a few slides and then have some discussions on what we're seeing, some of the fraud we're seeing and that kind of thing.
That'll be great. Thank you.
And I guess actually, sorry, I'll step back before I do that. I know that the slide that I saw had mentioned credit washing, and just so those that aren't aware, credit washing basically, well, there's a few reasons for it and a few types of people that do it. One are going to be people with low credit scores and it's really simple. Credit washing basically is just arguing or sending the credit reporting agencies something that indicates that, yeah, this isn't my debt. I'm saying that this isn't mine. Take it off, get rid of it, that kind of thing. And it's really very simplistic, and sometimes it ends up being really, when disputing these trade lines, a lot of times the creditors, they'll just, in order to make it easy on themselves, just take them off. Credit scores get increased right away. Those individuals try to get loans. Well, all of a sudden their credit scores go way up. Try to get loans, which they probably can't afford. And so that's pretty much what credit washing is. And it's pretty common, pretty easily done. Sometimes it's people that get recruited. A lot of times it's younger people that get recruited by some fake dealerships, things like that. And we'll talk about those things. And sometimes it's just crooked members or members that are, I don't know how to say it other than streetwise and understand how to use credit reporting systems to their advantage, get loans, file bankruptcy, hide cars, all those kinds of things. So does that make sense for what credit washing amounts to?
It does to me.
See if I can figure out how to share my screen.
Yep, we can see it.
Okay, so the indirect lending, and I just chopped some slides apart a little bit. Sorry about that. Some of the things that we've seen when we see losses due to indirect lending issues. One of the warning signs, and it's kind of, I guess, common sense, so to speak. But then again, credit unions often aren't really ready for it, and that's just huge, rapid growth. You get into indirect lending, all of a sudden, you see whatever 200-300% increase in auto loan balances in your portfolio, and everything looks great. And then all of a sudden, things start to creep up, increased delinquency, some repossessions. Your return on assets go down a little bit because of charge-offs with your repossessions. Lending staff ends up being, just overworked and they can hardly handle it. There's just too much work for them to do. Members complaining, credit quality challenges where if you're not careful, with the some of these indirect dealerships, they'll try to take advantage of credit unions and send you whatever garbage they can and hope that you buy it. So those are some of the warning signs for things that we see with indirect lending programs that go too quickly and end up being unsuccessful. And what we see sometimes is, a credit union will step into it, that they'll have these issues, they'll get away from it, and then maybe a few years later they'll decide, okay, we learned our lesson, let's start getting into it again. And certainly nothing wrong with that. Today's environment, however, that can be that can be kind of tough when you think about, all the people that are unemployed and all the payment forgiveness, skip a pays, things like that that are going on when it comes to the indirect members. If they're not real members, so to speak, they're not really going to care if they cause you a loss. So back to some of the controls and oversight with indirect lending, things to make sure that are monitored from an executive's point of view are going to be, new and loaded total loans by credit tier, by dealership. Do you have one dealership that is dominating and they're just sending you everything? And maybe sometimes what we see is you may have a specific loan officer that approves everything because maybe they're compensated that way by loan approvals. Well, then a lot of times those loans end up going bad. So just things to look for trends and anomalies. As you see here, delinquency by dealership and loan officer, obviously something to look for that can be an indicator that there's an issue with either a dealership or a loan officer. Delinquency by credit tier and score, pretty obvious to look there. Charge-offs, kind of same type deal. One of the things that we highly recommend is, and maybe it's on the next slide, it'll be coming up. Anyways, that is to establish limits for lower credit tier indirect loans. We've seen some that are really in some credit unions really get heavily into some subprime lending, D&E paper, so to speak, if you want to call it that. And with the idea that, well, we think most of these people are going to want to pay for their cars because they have to use their cars to get to work, kind of a deal. Like I said, lower credit tier scores. And then they find out that, well, no, actually those people don't care. And then they'll end up getting a loan somewhere else after you repossess that. Ends up being garbage. And so that's one thing definitely to look at and consider is if you're going to get into the heavier, higher amounts of D&E paper, subprime lending, can you really charge enough for in interest to make up for the charge-offs that you're going to have? And it'll usually take a year or two to find out what the charge-offs you're going to have are. So it's kind of, you're in the dark there. And our suggestions usually are, thinking about maybe 15% with D&E, 10%, 12% in D, maybe a couple percent in E, or avoiding E altogether. It just kind of depends on what your appetite, your risk appetite is. So one of the big things with the indirect lending is selecting dealerships. And I guess with Vermont, you guys probably don't have, and maybe I'm mistaken, but you probably don't have, what I would be used to. And I live in the Detroit area where there's, hundreds and hundreds of dealerships. But definitely things to think about when choosing a dealer and performing some due diligence. You can see here on the slide, you're gonna want to look and see what the dealership is all about. I guess maybe that's one way to put it. And boy, I think this somewhere I saw a Cuddle related to this. So when you're using a third-party service, obviously that makes a bit of a difference. You probably have more choices for dealerships. But if you're doing it directly, these are some of the things to think about: reviewing complaints against dealers, looking at their financial reports, confirming that they have the appropriate licensing status in the state for sales of the vehicles, looking at past and current lawsuits to see if there's any concerns there. A few more ideas: requesting their business insurance, see that they have adequate coverage. If they're a dealership that does service, look to see that they have garage keepers coverage, so to speak, in case they ruin somebody's car. They do that a few times. They can end up going out of business, and then you could end up without somebody to turn back on in the event that there end up being some complaints or lawsuits from members that bought cars there. And then looking to see what type of compliance management system or program that a dealership has in place. Especially, this is definitely, certainly very important in the event that your credit union is going to allow dealers to, or dealerships to mark up what you may have as a buy rate or a stated interest rate. And that's pretty common. So those are things, and I'll get back to that just in a second here. Some of the things for dealership contracts to look for, documentation standards, conditions of vehicles. Really, I guess I'm looking at this, probably one of the most important things is to have some indemnification language in the contract itself. And we see that really come into play and saves credit unions hundreds of thousands, millions of dollars a year when it's in there. And when it's not, it's kind of the same thing. We see dealer or credit unions losing a lot of money. And indemnification basically meaning language that says if the dealership did something that causes a loss, misrepresented the vehicle. A lot of times what we see is lemons are purchased, or a member borrower, which becomes a member, purchases a vehicle, gets a loan from the credit union, and then maybe, for example, finds out that actually the vehicle is a lemon. They sue the credit union, they sue the dealership for selling them, a lemon vehicle. They sue the credit union because you're holder of the note, and is the dealership going to make the credit union whole? Well, with the indemnification language in there, yep, then you can have that language in there that says the dealership's going to defend the credit union in the event of these types of lawsuits. It's all legal type language, but that's really, you want to make sure that you have that in your dealership agreements, just to make sure in the event they do something like that, or sell vehicles like that it's not going to end up going on the credit union. So a few things for ongoing dealerships: visiting dealerships periodically, requesting proof of insurance annually, confirming licenses, reviewing financials, reviewing success of the dealership. Do they send you anything or not? Sometimes, we see a lot of credit unions that they just end up dumping dealers out of their program, basically because they send them garbage, they get no loans. The few loans they get have issues. So, nothing wrong with just deleting them from your program, telling them, forget it. And a lot of times that'll happen with B dealerships. I guess one way to put it is A dealerships being dealerships that are franchised from like a General Motors. All they sell is GM cars or Toyota cars, whatever the case may be. And B dealerships being, well, for the most part, used car dealers, which can be a little shaky, but it's up to credit unions as long as the loan looks good and you can verify that the dealer has right to sell the vehicle, then hopefully everything works out. A few things with internal controls, of course, policies, procedures need to be in place. Who can approve, who inputs, monitoring, collection, charge-offs. Really, it's best to have a decent segregation of duties when it comes to the person that's going to approve from a dealer versus who has the relationship with that dealer. And what I mean by that is for the most part, have somebody that gathers the dealerships, signs them up for inclusion in your program, and not have that person allowed to approve any loans. What we've seen in the past is they get into cahoots, so to speak, with a specific dealership or a salesperson, and end up putting a bunch of bad loans, fictitious loans on the books. And we've seen like $7, $8, $10 million losses because of things like that. So just keeping an eye on things, really, I guess, kind of common sense, make sure somebody doesn't have all the keys to everything. Here's a quick example. A branch manager had opened a bunch of accounts and approved, had a bunch of direct loans for family members, a bunch of them. She just changed the last names, stole the proceeds, advanced loan due dates, dealership documents. Some of them were real, some weren't, and basically just altered everything to look like that they complied with credit union policies and procedures. And it was 400,000. And if I recall correctly, I think this took about 6 weeks for this one specific branch manager. And this happened right when they got into indirect lending. The branch manager just went wild and 400,000 out the door almost immediately. So we had talked about allowing dealerships to increase an agreed upon buy rate. Just wanted to mention, here's a instance where it's really, sometimes it can be a mess and sometimes it works out fine. And really, I guess the main thing is if you're going to allow dealerships to increase your agreed upon buy rates, or your agreed upon your standard, your normal interest rates, just be really careful. Make sure that dealership has what we had mentioned a little bit earlier, a compliance management program, so that they're not increasing those rates based on some type of protected class. And here you can see some of the CFPB, PB, I guess they changed their name now, but issued consent order a couple of years ago, 29.1 million. I think that might have been for Honda Finance or Toyota, just because restitution for increasing rates on something that didn't seem right with specific protected individuals versus non-protected individuals. And again, here the investigation didn't sign that they did it on purpose, but their compensation policies, the institution's compensation policies resulted in discriminatory lending by the dealership. So basically, the dealerships would up the rate. The financing company, they were just approving pretty much everything that qualified without really paying attention to what the dealerships were doing. So those are definitely things to look out for in the event that you're going to allow dealerships to increase interest rates. And here's just a couple ideas, things to have in place. Really, I guess we kind of looked at this a little bit, limitations for each credit tier, making sure that you've had an attorney review your indirect dealership contracts is a great idea, and have them do it on your behalf. Don't just use some standard template that somebody gives you. Make sure you have an attorney review it on behalf of your credit union to make sure it makes sense for you. And we talked about the compliant management systems that you want to make sure when you are having allowing dealerships to increase your standard interest rates. And a lot of times they'll either keep the difference or give you a small cut, but that incentivizes them to increase rates. So here's some ideas to think about, analyzing loan level data for disparities in the pricing and underwriting, reviewing maintenance of indirect loans for loan officers maybe hiding something that may be going on. Pretty much, I think, some common sense. One thing that we've seen in the last couple of years are phantom loan scams. And that's really, we've seen all around the country. And I don't recall if Vermont was one of the states, but probably about 15 different states where basically, well, here's a lot of words, but basically it's people creating fake dealerships, getting licenses through fraudulent documents with the states. They hire people or have people go to real dealerships, get VIN numbers, and create, recruit people to pretend like they're buyers, join the credit union, especially if people have on your credit unions offer online joining of the credit union. They hire people to join the credit union online, get these loans for vehicles that aren't actually owned by this fake dealership. Credit union ends up finding out when they go to collect on the delinquent loan that, well, actually, that automobile wasn't owned by that dealership. It wasn't sold to that person. And we've seen, six, seven, $800,000 losses for credit unions on that. So, few risk mitigation tips on these, looking at the loan types, looking at the loans for any type of fraud. One big thing is when I think that's super simple, when adding a dealership to your indirect program, just Google Earth a dealership and see if it actually exists. On two of these cases, they had these fake dealerships. The addresses, one was a empty parking lot, and the other was a restaurant. So that was just me helping out a credit union. It's pretty obvious those aren't dealerships.
And Doug, at our Cuddle program, we actually have our Cuddle. We have a person who goes out and visits all the dealership just to make sure, they do the due diligence and everything so that they're guaranteed that it is at a reputable dealership.
Oh, that's perfect. Definitely. Absolutely. And that's, there you go. That pretty much squelches that potential risk. And like I had mentioned, there we've seen some credit unions losing between $500,000 and $1 million just in, 10, 15 loans that, are 30, 40 grand each. I think I can't hear anything, but those are some of the things that I wanted to bring up or thought might be of interest for people to think about. And I know this is a roundtable. Whatever questions, or I'm here to join in on the conversation, whatever I can do to help.
Now, does anybody have any situations or anything that you want to run across Doug? And then you can also type in the chat if you want. We live in Vermont, so it's really nice that everybody here is honest.
There's no crime in Detroit either.
I don't know about that one.
Okay, maybe there's too much.
Melissa, did you have a question? Nope.
One
Oh,
other
no.
thing that
No, she said
Okay.
she was good.
One other thing that we're seeing that people are doing with, it's not necessarily credit report washing, but it's still manipulating credit scores, is what's called piggybacking. Unfortunately, and actually, and I got a call today from some company that said something about, do you need your credit report or credit score fixed? And I don't need my credit score fixed, but there are companies out there that are contacting individuals that they even advertise on television, things like that. Especially right now with today's environment, so many people being unemployed or temporarily unemployed and maybe getting behind on their loans, worried about their credit scores. Some of these firms that are pretty shaky will contact individuals. One thing that's very illegal that they do is charge the person up front to help them repair their credit scores. And what they'll do is actually find other individuals that have good credit scores, put the first person that they called that needs their credit repaired as an authorized user on somebody that has good credit, and they'll pay that individual 50 or $100. Hey, do you mind? I'm putting Joe Blow on your credit score. Here's $100, or on your credit report as an authorized user, even though Joe Blow won't have a card or anything. It's just to help this person out, if you don't mind. And sometimes they acquiesce. Sometimes they don't even ask. They just do it. Put it on there as an authorized user. So that's one thing kind of to look out for is when you're reviewing loan files, if somebody maybe had a weak credit score and all of a sudden they have an improved credit score, look to see, is most of their good credit because they're an authorized user on an account, not because they're the owner of the account. So it's called piggybacking. So just thought I'd bring that up, something to look out for that we see going on more, unfortunately, more and more now, just because of the delinquency rates potentially going up and the people having some issues, when they're unemployed.
Now, we have a credit union that said that they have a dealer that submits a deal for the same borrower each month. And sometimes they haven't even made the first payment. So it sounds like they've booked the loan, the credit union, and then they go back to the dealership or a different dealership and look for another loan and to
Or,
pay off the other one.
okay, that's probably, I don't know if it's, yeah, there's obviously definitely something fishy there. If there's already a loan, there's a confirmed lien on the first loan. Sometimes we see people, it's called loan stacking, that will right away try to just get a bunch of loans in a hurry, and then they end up filing bankruptcy.
Oh,
Now, I don't know if that's the instance here where that individual is trying to stack loans in a hurry before they get caught, but that would be something to look out for sure.
yeah, no, especially if a person, I mean, I don't know, maybe they are not liking the vehicle that they have, or if they are just trying to stop that first payment, and just keep going on with the cycle so that they don't have to make a payment.
Absolutely. Yeah, definitely something. First payment defaults, if especially with an indirect dealership situation, we do suggest, or I always suggest, seeing if the credit union can get away with putting in the contract, first payment defaults have to be, the credit union has to be reimbursed for the whole loan amount.
Yep.
Some dealerships don't really pay attention to when you have them sign the contract. They're just happy to have you as a lender. So a
Right.
lot of times you can put in their first payment default language so that then the dealer has to pay off the loan and you're just done with it. You can't lose a dime.
Right. Yeah, that is nice. Yeah. And the credit union said that the same dealer and the same member is the situation. So they're just keep going back to the same dealership and it's the same member and they're trading in that auto loan.
So if it's happening real quickly, something fishy is up there.
Yeah.
And I would probably, if the person is already a member, ask the member what's going on and why, especially if it's the same salesperson at the dealership. Ask them actually what's going on. Ask them to be honest with you, that, hey, this looks like something kind of fishy that may or may not be, proper. What can you tell me? Why is this happening? Have you actually purchased a vehicle? That actually is one thing to look for. Maybe the person never even got a vehicle, and this is just the dealership forging documents.
Oof, I hope not. Does anybody else have a situation or anything that you want to run by Doug? Oh, and I am told that for you credit unions out there, the dealership in questions is Royers Auto. So if you have them on your list, then, and I have a credit union that said they've already shut them off. So it sounds like they may be a little issue.
Yeah, sometimes dealerships can have fishy employees, and
Yeah.
one of the things I would look for, which is very common when it comes to salespeople in dealerships, especially the maybe not so honest ones, is they'll move from dealership to dealership. So
Yes, they do.
if you identify one that has been trying to sell you a bunch of garbage, then all of a sudden they're, watch for that name, so to speak. I guess I'll put it that way, or make sure your indirect loan officers know of that name, so when they go to the next place, you can keep an eye on things.
Oh yeah. Yeah. I can remember when I was doing indirect loans, we had a situation like that, where the person was doing some really bad stuff, and then he left Vermont for a while, and then I was going out on the road doing dealer visit, and I found him at one of these dealerships, and I was like, yeah, we're not gonna keep them on, because no way, we got to be careful.
I remember you.
Yep, that's right. Sometimes people don't change.
Absolutely.
Does anybody have anything else? No? Well, thank you, Doug. I really appreciate it. We're going to take a quick break, and then when we come back, it will be the final session with our team of Origins.